Okay. All right. So we are now to chapter 11 of the text. So we only have 11 and 12 left. So chapter 11 is all about reporting and analyzing stockholders' equity. So some of this is going to look a little bit familiar with you in the sense of like issuing common stock, like the initial part of it's going to look really, really familiar. So that's a good thing. And then we're going to look at, well, let me go to the next slide here and show you. We're going to look at common stock and preferred stock. So the first thing we're going to revisit just really, really quick is that, so corporations are organizations that sell stock. So that's when we're talking about stockholders' equity, we're talking about the individual stockholders that own a piece of the company. If it was a sole proprietorship or a partnership, it would be called owner's equity versus stockholders' equity. So it's the difference with who owns the company. So we can have corporations that are nonprofit or for-profit, and nonprofit does not mean they don't make money. The difference is that in a for-profit, they make a profit, and then they distribute that profit to their shareholders or to various things within their company. A nonprofit or a not-for-profit, when they make money, that money goes back into whatever their cause is. So like, for instance, when I worked for a secondary private high school and I did all the accounting, we were a nonprofit. So that meant we used zero-based budgeting. That meant that everything that came into the company, we had a budget item for it to go back out. But sometimes we would get donations that would be over and above what we thought was going to come in. So we would always have a running list near the end of the financial year, and it would be a list of things that we wanted. Like maybe we wanted new desks for the science department, or we wanted new football uniforms for the football team, or whatever it happened to be. And then when we got down to the end of the year, when it looked like we were going to have money left, a profit, we would actually put that money into things that we were offering at the school in order to remain our nonprofit status. Now, companies that sell stocks can be publicly held or privately held. So publicly held companies are companies that any of us can go out and buy stock in. Like, so we can go buy stock in Apple or Hewlett Packard or whatever we want to go buy stock in. But if it's privately held, we cannot. Privately held means that the organization only sells stock to select individuals. Usually, it's the management level of the organization. However, there are some privately held organizations that sell stock to only their family, but then they extend it to the managers. So it just depends on the company. So an example of they have here for an example of a privately held company is Cargill, but actually, I don't know, I think it's an Eastern or East Coast company. But one that's all around us here is In-N-Out Burgers. So In-N-Out Burgers is a privately held organization. So they do sell stock, but they originally only sold stock to their family members. And now I believe they sell stock to their high-level managers as well. And the reason why they do that, they don't want to sell stock and get it out into the market, because when they do that, then they lose control of their company, because then the decisions of the company are made by a board of directors and they have less control. So they are a Christian-based organization, and that is one of their primary reasons why they do not want to be publicly held. They do not want to lose some core values that they run their organization by. So we can see a variety of companies that are corporate that sell stocks. Now, we've talked about this before. This is just kind of a reminder. This is not anything that's on the exam, but the advantages are that there's limited liability. The only liability for stockholders is however much money they own in stock. Nobody can come after their personal possessions or anything. You can transfer ownership just by selling the stock. They can easily acquire capital by selling more stock. They have a continuous life, so they can continue to operate no matter what happens to, stockholders pass away or move on to other companies. They still continue to operate. Separate legal existence. The disadvantages is that, the corporate management, so the owners of the company lose control when it becomes corporate management because decisions are made by a board of directors. There's more government regulations, there's additional taxes. So like everything, there's some pros and cons that come with a corporation. Okay, so I already said all that. This is just kind of showing us what an organizational chart looks like. And if you're a business major, you're going to see multiple organizational charts. If you go to work in accounting, you could end up working in this bottom right-hand box that says controller, or the left-hand box that is treasurer, or the vice president of finance, the chief financial officer. You might work in that area too. So you could work in any of those three, or you could work in someone below those. So you could work below the controller or below the treasurer. The other forms of business that we talked about, this is way back to week 1, ages ago, 30-something V classes ago or live classes ago. Limited partnerships, limited liability partnerships or limited liability companies, S corporations. These are all different forms of ownership. And then, of course, just straight partnerships or sole proprietorships. So when an organization forms a corporation, they do it by filing an application with the Secretary of State, and the state grants a charter, and the corporation develops its bylaws, which is basically how they get things done. It's how they go about running their organization. And companies generally incorporate in a state whose laws are favorable to corporate. So for instance, to corporate forms of business. So for instance, if you look at a lot of credit card companies, a lot of them are formed in Maryland. Because there's more lax corporation laws there. So that's kind of interesting. But corporations engaged in interstate commerce have to obtain a license for each state that they are doing business in. So with stocks, sometimes with stocks, what comes are a right to vote. And the right to vote is a right to vote in electing the board of directors and any kind of actions that require stock approval. So this is where in the movies you'll see things where they say there's a stock takeover. So that's when an individual or a group owns 51% of the stock. They have what's called controlling interest because they're able to use their votes to kind of steer the company in the direction they want. So that's why sometimes organizations will buy their own stock back and put it in the treasury, which we're going to learn how to do the accounting for that, in order to prevent someone from doing a stock takeover. Now, the way companies make, or the way individuals make money from stock is they buy stock low and they sell it high. They buy a stock for $1 and they turn around in 6 months and they sell it for $3. So they've made $2 per stock. The other way people can make money is that some stocks pay dividends or they pay interest to the stockholder, and dividends are paid at different times throughout the year. Not all stocks pay dividends though. So like for instance, if you buy Apple stock, you will not get dividends for Apple stock. The only way you make money on Apple stock is buying low and selling high. Now, the other thing that we see for stockholders is that they have preemptive rights, which means that they have the same percent of ownership within the company. So if a company decides to increase their shares, so say they have 1,000 shares and somebody owns 500, and they increase it to 2,000 shares, then that individual would now own 1,000 shares. So you still have the right to own the same percentage of stock that you had originally. Now, technically, this is kind of a funny slide because technically, stockholders' rights include what they call a residual claim, which means that when a company goes out of business, they liquidate their assets. So that means that they take everything they have of value. Remember, way back in the beginning of the class, we talked about what an asset is, and I said it's something of value that you can sell if your company goes out of business, and you can get cash for it. So when we look at this, technically what happens is stockholders can get claim to that money in the sense of their stocks are paid out to them. But in reality, if you look at this, this picture here, what normally happens is that when they go out of business, there really needs to be one more little bag of money there right after they're going out of business, and that's taxes. Organizations need to pay any kind of taxes or liens that they have. Then they pay their lenders and creditors, and then whatever's left goes to stockholders. So when an organization issues stock, when they do their charter, they talk about how much stock they're going to be issuing, how much the corporation is authorized to sell. And the number of authorized shares is often reported in the stockholders' equity section of the report. And that's something that we haven't seen up to this point. So when organizations issue stock, they can issue it directly to investors or indirectly through investment banking firms. Most companies go through investment banking firms. Like, you don't call up Apple on the phone and say, hey, I want to buy some stock. No, you would go to an investment banking firm and say, yeah, I want to buy some stock. And they'd say, okay, well, what kind of stock? And you'd say, oh, I want to buy some stock in Apple. So you would do it that way. This is kind of a picture of what a stock certificate looks like. Again, you know, we don't see these certificates so much today because everything's done electronically. So we get more of an electronic confirmation of what our what the stock is that we purchased. Okay, so now this is something important that you need to make note of, all right? When we talk about stock, stock is either called par or no par. And no par stock can be called no par, or it could be called stated value. So par stock is kind of the way this kind of came around is that par stock is almost like saying that the stock is insured. So if the company sells $1 of stock, it has $1 in savings to cover that stock, so that if the stock market crashes, they can still pay off the stockholder. So historically, par value stock was really common. It was something that happened a lot. Now it's not so much a requirement. Many states don't even require it, any par value stock anymore. So we'll see that no par value stock is very common, or what they call stated value is very common. But par value stock is not as common anymore. Okay, let me see what this one is. Do it 11-1. I'm not sure we're going to do this one. So let me stop it. If we're going to do it, I'll do a separate video. So let me stop the video here.